Oil prices move markets fast, but when oil approaches major psychological levels, the economic consequences get much larger. One of those levels is $100 per barrel. For global markets, $100 oil isn't just a number. It's a signal. Energy sits at the center of the global economy. Oil fuels transportation, manufacturing, logistics, shipping, and agriculture. So when oil rises sharply, the impact doesn't stay inside energy markets. It spreads through supply chains. It shows up in inflation, and it influences central bank policy. That's why investors watch oil so closely. Because oil isn't just a commodity, it's an economic transmission mechanism. The first effect of higher oil is cost pressure. Transportation gets more expensive. Shipping costs rise. Airlines, trucking, and logistics firms face immediate margin pressure. Manufacturers pay more to move inputs and finished goods. And because energy is embedded in almost every step of production, the price increase gets passed along. Not always immediately, but steadily. This is how energy shocks often become inflation shocks. Even if food and rent are stabilizing, oil can push headline inflation higher by raising costs across multiple categories at once. For central banks, that creates a difficult problem. If inflation is cooling, markets begin pricing in rate cuts. Risk assets rally. Financial conditions loosen. But if oil spikes and stays elevated, inflation expectations can rise again. That can force central banks to hold rates higher for longer, or delay cuts that markets are expecting. That is where oil becomes a monetary policy variable. It changes the entire macro narrative. And it changes how markets price risks. A sustained rise in oil can pressure equity valuations, especially in rate-sensitive sectors. It can tighten credit conditions. It can raise borrowing costs for businesses already operating in a high-rate environment, and it can weaken consumer confidence because fuel prices are visible. People notice gasoline prices more than almost any other inflation metric. When fuel rises, consumers often feel inflation returning, even if other prices are stable. That reduces spending confidence. And spending confidence matters for growth. Now zoom out globally. Oil shocks do not affect all countries the same way. Energy importing economies are typically more vulnerable. Higher oil increases trade deficits. It weakens the currency. It raises the local cost of imports. That can create a second round of inflation through exchange rates. This is especially dangerous for emerging markets that have large dollar-denominated debt. Because when oil rises and the dollar strengthens, debt servicing becomes harder. That combination can trigger capital outflows. Investors rotate into perceived safe havens. The result can be currency pressure, higher borrowing costs, and reduced growth. On the other side are energy exporters. Higher oil prices can increase government revenue, improve trade balances, and strengthen currencies. That creates a redistribution of economic power. But even energy exporters face risk. If oil rises because of geopolitical fear, markets can become volatile, and volatility affects investment planning. So the question is not only whether oil rises, it's whether it stays high long enough to reshape expectations. That's the real difference between a spike and a macro shift. So what would cause oil to hit 100 and stay there? There are a few scenarios. One is supply disruption. If production is cut unexpectedly or transport routes face instability, risk premiums rise quickly. Markets price the possibility of disruption even before it occurs. Another is capacity limitation. If global spare capacity is thin, oil markets become fragile. Even small supply disruptions can cause large moves. A third scenario is demand resilience. If global growth remains stronger than expected, energy demand stays elevated. That keeps pressure on prices. And then there's the policy layer. Strategic reserves, production decisions, and sanctions all shape supply and sentiment. These are not purely market-driven commodities. Oil is heavily influenced by politics and policy, which makes it more volatile. Now here's the key point. $100 oil does not automatically mean recession, but it increases the probability of economic stress. Why? Because it acts like a tax on consumers and businesses. More money spent on energy means less money spent elsewhere. Margins compress. Households pull back, and growth slows. If oil stays elevated long enough, it can slow demand across multiple sectors at once. That's where macro risk rises. But markets also adapt. Higher prices encourage production. They encourage substitution. They accelerate investment in alternative energy and efficiency. The timing is the issue. Adaptation takes time, and markets can experience significant volatility before adaptation stabilizes the system. So what should you watch if oil is rising? First, watch inflation expectations. If oil rises and inflation expectations rise with it, central banks become more cautious. Second, watch bond yields. If yields rise on the idea of higher for longer, risk assets can reprice quickly. Third, watch currencies. A strong dollar combined with high oil can stress import-dependent economies. Fourth, watch credit spreads. If markets begin pricing growth risk, borrowing becomes harder. All of these signals can move before the real economy shows stress, because markets are forward-looking. That's why oil matters so much. Not because it guarantees a crisis, but because it changes the probability distribution of outcomes. It makes good outcomes harder, and bad outcomes more plausible. If oil spikes briefly and retreats, markets may stabilize. But if oil pushes toward 100 and remains there for months, the macro story changes. Inflation becomes more persistent. Rate cuts get delayed. Currencies get stressed. And volatility compounds. That's why $100 oil is not just a headline. It's a macro signal.